Well, hello and welcome to Global Mantra, the series that brings to you prominent fund managers from the City of London and gets their views on the global market situation. Joining me on the show today is a very special guest, a man who needs no introduction. Jim O'Neill, chairman of Goldman Sachs Asset Management Company, is right here with us. Jim, it's great to have you. Thanks very much for taking out the time for this.
My pleasure.
Okay, let's start off by talking about the acronym BRIC, which you coined in 2001.
Yeah.
You know, we've seen the story out there play itself out over the last 10 years, but you're still very bullish about the story over the next 10 years. I mean, the decade that we are in right now.
Yeah.
What are the projections and trends that you foresee?
Well, in some ways, we're in the early innings of a big strategic story and the biggest of our generation. If I look at the work I've been involved in with my colleagues, this decade we've just started, the combined GDP of the four BRIC countries, which is currently between 11 and 12 trillion dollars, it could increase by the same amount again this decade. You know, we could have another aggregate BRIC created by 2020, and certainly before this decade is over, the aggregate size of the four BRICS will overtake the US.
Yeah.
So,
exactly.
so what started off 9.5 years ago as some sort of idle, speculative, long-term projection looks like one part of it is going to happen, and it's just a huge story. It's dominating everything. And if you're asking me, is the whole BRIC equity story over? Not at all. I find it fascinating in the current environment. It's sort of quite popular to sort of like DM and not like EM. But as I joked to something, nobody told the Chinese about that. The Chinese stock market's up this year. And since the Chinese New Year started, Chinese markets being one of the stronger markets around the world. So, of course, it's still a big story for the equity markets.
But you have said that, you know, outperformance of these markets is perhaps unlikely from these levels. Is that a case? But you still expect solid returns?
In November, I made a big point of saying that, you know, the next surprise is going to be that the US is on the way back. And I thought, and it's broadly speaking what's happened, the US markets would outperform and you would have money moving back from other markets, including the BRIC markets, to the US, and that's happened. Now we're in March, and some of the markets, particularly India, have fallen quite a bit, and I'm not quite sure that it will continue. And by the end of the year, or if we were talking 2 weeks ago before the Japanese situation, I would have sat here and said, yeah, I would have expected all the BRIC markets to recover, particularly China. China might be on the verge of another big bull market here.
What's your conviction in China at this point? I mean, where does the confidence come from? Because there are concerns in China as well, which cannot be not discussed. But
well, listen, you know, people have concerns about everything all the time, and you know, the name of the game is when is the market priced in all the concerns and not worried about the good things. And what I find interesting about China, people are talking about overheating and inflation, and the indicators that I've developed 10 years ago and still use and follow closely, they increasingly suggest to me that China is achieving what you might call a soft landing. China's economy is definitely slowing down, and it might well be that Chinese inflationary pressures are peaking. So I think much of the concern that people talk about China, as is often the case in financial markets, they're looking through a rear-view mirror. The time to be worried about those things was 6 months ago, not today.
So what about return expectations from BRIC markets, specifically China and India, over, let's say, perhaps the next 3 to 4 years?
Over the next 3 to 4 years? Oh, I think you'll see these markets give you a good 10% on average over that period. By that, I'm not saying that they'll give you that every year, but I think on average they will. I think in the near term, I'd have a few concerns about India still, but I wouldn't about China. And actually in the BRIC world, rather controversially, the one that I like most at the moment is Russia.
Yeah, exactly. I was coming to Russia.
Russia's cheap.
So is that the only story? Is it a valuation play in Russia right now?
Well, I always like to combine three things: valuation, where is the policy momentum, and what is the consensus expectation. People hate Russia, it's cheap, and the policymakers at the margin are doing sensible things, but from a very low base. And the three ingredients together, from my experience, are usually a good thing for a market. So it's not just the fact it's cheap, but the price is a very important part of it.
But is it only being looked at as an oil story right now, Russia?
Not. It might be by many others. It's not by me. I think there's a couple of important things going on. There's some evidence that Russian demographics are starting to improve. Consensus expectations that Russia's population is going to decline dramatically the next 30 years. That might not happen. And then secondly, the policymakers are doing things to try and reduce the economy's dependency on oil and energy, which is very important because it has been a problem and remains a problem for Russia.
Aside of the BRIC nations, the other most talked about aspect is N11, the next 11 emerging markets.
Yeah.
I mean, you've spoken about markets such as Korea, Nigeria, Turkey, Vietnam, Mexico for that matter.
Yeah.
What's the expectation?
Here's my big philosophy in my new life as chairman of GSAM. I don't believe I never did believe the 4 BRIC countries should be called emerging markets. It's an insult, and it's from an investing perspective, it's inopportune. Emerging markets has a connotation of highly risky, a place you only go when you're looking for trouble, etc., etc. I think we've gone way beyond that. These countries are driving the world economy, and so for the 4 of those. And 4 of the next 11, Korea, Turkey, Mexico and Indonesia, those 8 countries are now sufficiently big enough to be treated as normal places. So I like to call them growth markets, and I don't think people should.
They always say that there's sometimes an opportunity in disaster or catastrophe. We'll talk about Japan in a bit, but also bring in the angle of Egypt, because many people think the furore there is actually leading to an opportunity perhaps relook at the country as an investment destination.
I have some sympathy for that. This is my 30th year in the investment world, and I often think I haven't really learnt that much, but one of the few things I have learned is never let a good crisis go to waste, and indeed out of many crises come the best opportunities. And when I've thought about the Middle East and North Africa in the past, I've never really treated any of them that seriously in a BRIC-like context, but 2 of them, Egypt included, are an N11 economy. And Egypt's got 80 million people, and this protest appears to be about a cry for wanting a better life. It's not anti-Western, it's not religious-based. And so I tend to have sympathy with those that have a more optimistic view of what this could mean, and I think Egypt is an interesting place to now think about, which was never really on my radar in the past.
Do you think, Jim, that these are tough times for long-only funds or for asset management companies because of the kind of surprises we're getting every week?
I think it's a very tough era for any investor, whether it's a long-only or a hedge fund. As I also touched on earlier, the speed at which information is transmitted to people is so powerful, is that people have the knowledge before the detail, and it puts pressure on you to consider the absolute worst. Because we had 2007, 2008 and the credit crisis, the phrase black swan has become part of so many people's daily behaviour. People look for black swans everywhere, and you see it. So whenever you get some disturbance in the world, people immediately assume the worst, which in a sort of psychological and social sense is quite fascinating, because it means you sort of have these intense bear phases, which also contradicts historical way of thinking. Classically, people talk about a bear market that goes over a period of X, but you can have it in a matter of hours.
Yeah. In that sense, do you think time cycles have compressed?
It depends on what your mandate is. I'm just fresh from speaking at a big conference for the National Association of Pension Funds here in the UK, and I had a dinner with some of the bigger ones the night after, and they were all, expressing their own concerns about how can they thrive and succeed in this environment. And my answer was, A, I don't know, B, get real. The idea that you can just sort of stand away from any news and claim that you're a long-term investor and you know, if you're a long-term investor in Japan, you know, you cannot have avoided being highly affected by what happened in the past week. And so people shouldn't think in terms of matters of weeks and months. It's like, how much exposure do you have to somewhere that can move a lot? And of course it makes it a very challenging environment for investors, whether they're long only or hedge funds. And you know, the ones that cope with this current challenge the best are the ones who will become the next superstars.
All right, we'll take a break on that now. But when we come back, we will discuss with Jim the macro risks to the global economy at this point, primary among which right now is, of course, the Japan disaster.
My general view is the euro gets close to 140, you sell it. Euro gets close to 120, you buy it. And with the pound gets over 170 against the dollar, you sell it. The pound gets down to 155, you buy it. The ECB appears to have told us they're going to raise rates next month. My guess is that they won't. I think the next big mover of the four is going to be probably a weakening of the yen.